Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
The $8.22 closing price for Ekso Bionics, that's EKSO, is not a resting equilibrium. It is the unstable center of a market structure that's just being violently pulled apart. On one side, you have these event-driven arbitrageurs pricing in a radical corporate transformation, and on the other, you have entrenched bears who are just betting on total failure.
Oh, absolutely. And that tension is built on some truly extraordinary metrics. I mean, we are looking at a stock with reported short interest soaring above, 42.92% of the public float. And the cost to borrow those shares is an astounding 70.06%. And while the headline days to cover ratio looks deceptively low, suggesting shorts can just get out easily, that number is, well, it's distorted by high-frequency activity. It just confirms this is an extremely crowded and I'd say fragile trade.
I see why you focus on the fragility, but that extreme technical setup is forcing a reckoning of the underlying value. I think the central disagreement here is whether the $8.22 valuation is a rational price reflecting the sum of the parts, the legitimate AI potential plus the guaranteed legacy divestiture, or if this is merely a transient price created solely by those short squeeze mechanics, vulnerable to any deal hiccup. I contend the price is fundamentally undervalued relative to the confirmed assets and the implied chronoscale equity.
And I come at it from a different angle. That $8.22 price is structurally inflated precisely because it assumes a non-binding term sheet is equivalent to a signed, sealed, and delivered deal. The price is highly exposed to massive impending dilution and just critical execution risk. If this complex merger fails, this stock reverts almost instantly to a struggling medtech microcap. The current pricing is betting on flawless execution. I'm focused on the immense probability that all this complexity introduces delays and, well, failure points.
Well, my thesis is grounded in what we call a sum of the parts, or SOTP analysis, which is just essential here because we're looking at two radically different assets bundled together. The current market capitalization is only around $23 million, and I believe it actively discounts the verifiable value. Let's do the SOTP math on the legacy business alone.
Go on, but let's be careful about treating stated intentions as guaranteed cash in the bank.
Fair enough. EKSO intends to divest the legacy exoskeleton business. Now, if we apply a very conservative sale multiple, say 1.5 times its trailing 12-month revenue, that generates approximately $27 million in proceeds. TTM revenue is just the total sales over the last year, a standard baseline for a strategic sale. If that $27 million is distributed back to the existing shareholder base, which sits at roughly 2.6 million shares outstanding, that alone justifies a return of about $10 per share.
So hold on. That's an interesting point, but that means you are essentially justifying the current $8.22 share price purely on the potential sale of what is fundamentally a money-losing asset.
Exactly. And if the legacy divestiture covers the current share price, then the 3% stake EKSO shareholders retained in the new Chronoscale Corporation is essentially free upside. If Chronoscale, the new AI entity, is valued conservatively at $500 million, that 3% stake is worth $15 million. Added to the legacy sale proceeds, the theoretical target price could easily shoot up to $15 or even $20 per share. The market, right now, is offering pure-play AI infrastructure exposure at a deep discount. It's basically giving it away.
I'm sorry, I just don't buy that valuation structure. Let me tell you why I think it's fundamentally misleading. The intense focus on the short squeeze setup, that 40% short flow, and the punishing 70% borrow rate, it completely obscures the underlying financial deal risk, specifically the dilution. We are basing all this enthusiasm on a non-binding term sheet that was just announced a few weeks ago.
But that squeeze setup only exists because the shorts are ignoring the SOTP floor value.
No, that squeeze exists because the execution risk is so high. If that deal collapses, EKSO reverts to a valuation based purely on the legacy business, a business that, despite some operational improvements, still reported a $1.4 million net loss in Q3 2025. This is a cash-burning anchor, And it's critical to remember that the merger mechanism requires Applied Digital to gain 97% of the new entity.
And the legacy divestiture is the mitigation strategy for that exact cash burn.
Only if it happens smoothly and quickly. And before we pivot too far into the AI side, let's talk about the structural strain we can actually see in the underlying market data. Look at the numbers on fails to deliver, the FTDs. Sporadic spikes, like the 63,144 shares recorded back on December 5th, 2025, they confirm that the securities lending market is incredibly tight. Fails to deliver means that a seller failed to deliver the securities they promised on the settlement date, signaling deep distress in the availability of shares. This just confirms the environment is ripe for a technical snap, but that snap will only move the price based on sentiment, not on finalized valuation metrics.
I agree the snap is technical, but it's a technical reaction to a fundamental undervaluation. Let's address the core asset then, Chronoscale. I view this transaction as a crucial backdoor listing that carries immense scarcity value right now. Public investors are, well, they're ravenous for pure-play GPU cloud exposure, and Chronoscale offers a way in.
But you're comparing this tiny slice to private market giants like CoreWeave, which was valued at $23 billion, and Lambda Labs at $2.5 billion. This isn't comparable to a 3% ownership stake and a newly formed entity that will likely have a restrictive lockup period.
True. But those valuations establish the market's hunger. We can still apply reasonable public market multiples to the new entity. The revenue base of Applied Digital's cloud business, which forms Chronoscale, is around $75.2 million. Applying a conservative 5 to 8 times revenue multiple suggests an enterprise value of $375 million to $600 million for the new Chronoscale. This validates the value I assigned to that small 3% stake. It is undeniably valuable exposure.
I'm just not convinced by that line of reasoning because it willfully neglects the mechanics of the deal that make that 3% stake possible. To get to that valuation, we have to talk about the dilution. That 3% ownership for existing Ekso shareholders necessitates massive dilution to achieve the 97% ownership for Applied Digital. My concern is that much of the retail enthusiasm here is fueled by confusion. The assumption is that the current small share count remains static against the full valuation of a multi-hundred-million-dollar AI firm.
Well, the share count will certainly increase dramatically post-merger to reflect the true value of Chronoscale. That is just how the new company's structure will be priced by institutional investors.
The average person following this story doesn't fully grasp that 97% of the new company effectively goes to APLD. They are valuing a razor-thin slice of the pie based on the size of the whole pie, without acknowledging how much equity they are giving up to acquire that small piece of the AI growth. This structural risk is what the shorts are betting on. Not that Chronoscale is worthless, but that the deal terms are profoundly dilutive to existing EKSO holders.
I believe the market is intelligent enough to price in dilution if the underlying assets justify the growth. But let's turn back to the legacy anchor, because that is the immediate risk you cited.
It absolutely is. Until that divestiture is finalized, the cash burn continues. That $1.4 million net loss in Q3 2025 doesn't just go away because a deal is announced. This cash drain necessitates further potentially dilutive capital raises, which we saw with the $3.7 million registered direct offering in October 2025. The bear case fundamentally rests on the legacy business being significantly overvalued if the deal fails, and the ongoing cash drain reducing the equity value even if the deal succeeds but gets delayed.
And that's an interesting point, though I would frame it differently. The legacy business isn't a stagnant anchor. It is a stabilizing, high-margin asset being prepared for a premium sale. They achieved a significant operational milestone in Q3 2025 with gross margin expansion to 60.3%. That is an extremely high margin for a hardware medtech product.
High gross margins are good, sure, but they don't prevent the net loss, which is the key indicator of solvency risk here.
But high margins make the business fundamentally attractive to a strategic acquirer. When you look at potential buyers like Zimmer Biomet or Stryker, they're buying a high-margin unit they can integrate into their larger existing structures, allowing them to strip out the public company overhead cost. Furthermore, the company's recent acceptance into the NVIDIA Connect program to build a foundation model for human motion, that boosts the legacy asset's technical appeal.
The legacy business has its own little AI narrative, which should boost the premium for divestiture far beyond that conservative 1.5 times TTM calculation.
That is all future-forward positioning, not a confirmed sale price. So let's return to the immense gravity of this short squeeze dynamic. You argue it's a rational catalyst, forcing value discovery.
It is absolutely a rational catalyst. The high short squeeze score derived from the massive short float and that crippling 70% borrow fee means the market structure mandates a violent reaction to any positive news. If management announces a definitive merger agreement or, critically, executes the asset sale, the shorts will be forced to cover into a liquidity vacuum. This creates a massive, violent upside that simply forces the price toward the fundamental sum-of-the-parts thesis, much faster than traditional markets would allow.
Equilibrium, not certainty. While the daily cost to borrow is painful for shorts, it does not magically remove the fundamental deal risk. The entire situation hinges on the competence of CEO Scott Davis and his team to execute this two-part, tremendously complex structure, divesting the medtech business while integrating the applied digital AI infrastructure pivot. If management stumbles on the asset sale or the definitive merger agreement, the structure collapses, and those short squeeze mechanics unwind instantly, leaving the stock vulnerable to a rapid, steep decline. The squeeze is a temporary distortion.
The complexity is certainly extreme. I'll give you that, but Davis's background aligns well with this pivot. His experience in complex wireless technology and corporate restructuring is arguably a better fit for navigating this AI infrastructure deal than his previous med tech focus. This is not a situation where the CEO is fumbling. It's an architect executing a high-stakes, asymmetric wager with clear stated goals.
It still remains a high-stakes wager, based on the probability of success, not on confirmed pro forma financials. The current price is ultimately a function of that probability, intersecting with an extremely tight, fragile market structure. And that's why investors need to understand the true risk.
So our divergence remains clear on where the core value lies. I maintain that the market is currently mispricing an asymmetric wager. The quantifiable upside potential derived from the chronoscale stake and the $10 per share cash proceeds from the legacy sale, that far outweighs the downside exposure to the legacy cash burn. This fundamental floor is justifying the extreme volatility we're seeing at 822.
And I'll just reiterate the critical importance of recognizing the non-binding nature of the current deal structure and the massive threat of impending dilution necessary to facilitate that 97% ownership transfer to Applied Digital. The price action you see is primarily a function of the structural short mechanics, the crowded trade, and the unsustainable borrow fees, rather than confirmed pro forma economics of the new company.
Absolutely. Whether you view EKSO as a deeply undervalued growth vehicle or an over-leveraged special situation, it remains a high-risk special situation that requires intense, ongoing scrutiny.
Indeed. The critical next steps for investors are monitoring the filing of the S-4 registration statement, which will confirm the exact post-merger equity and valuation mechanics, and keeping a very close eye on those borrow rate trends to gauge the proximity of any potential squeeze catalyst.
The complexity of merging a medical robotics firm with an AI infrastructure play demands exactly this level of scrutiny, and it really underscores that complexity often requires multiple perspectives to fully appreciate the risks and the rewards inherent in a unique transaction like this one.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.